Welcome back all of you. In the last couple of lectures we have been talking about forward contracts. We have talked about the salient features of these contracts. These contracts are essentially privately negotiated contracts between the two parties. The contracts entail the delivery of the asset at a future date and the payment of the price at the same date. However, the terms of the delivery including the price are determined as at the time of the negotiation of the contract as at the time of the agreement. The important thing here is to keep in mind that this is a private contract, and being a private contract, both the parties to the contract have opportunities to assess the creditworthiness and the ability of the other party to honor his leg of the contract. And therefore, since the outside world is not involved in any way into this private transaction, the transaction is more or less very simple. However, when we move from the forward contracts to the future contracts, which are essentially the same thing, future contracts have a have an identical payoff profile to the forward contracts. However, they have certain distinct features. The fundamental feature that discriminates or segregates futures contracts from forward contracts is that they are tradable, that is, future contracts are tradable on an exchange. Now, because futures contracts are tradable on an exchange, two consequences immediately arise. They must have counterparties to facilitate the buy sell transactions. In other words, there should be sufficient liquidity. Liquidity can only be maintained if these contracts have some kind of a standardization attached to them. So, the first thing that we need to look at when we talk about futures contract is that they have to be standardized. In contrast, forward contract being private to two parties may be tailor made according to the requirements of the two parties and be settled accordingly. However, because futures are tradable, they have to be standardized. You cannot find counterparties for futures contracts that have a very unique amount underlying the contract or a unique index or such similar situations. They have to be standardized in terms of the underlying asset, in terms of the delivery process and so on. That is what we are going to talk about today. The second issue that necessitates that follows as a corollary when we talk about tradability of these contracts is that there should be no risk component, no default risk attached to those contracts. Let us understand why. When we talk about forward contracts, it is a contract between two parties. As I just mentioned, these two parties have between themselves assessed the worthiness, the ability of the other party to honor his leg of the contract, and therefore, no issue arises. Whatever default risk is assessed by the party, and by entering into the agreement, that party has impliedly accepted or acknowledged the extent of default risk that he is taking as a constituent of the contract. However, in the case of futures, because the contracts are tradable, the two legs of the contract may be transferred to other parties without the consent of the parties who initially entered into the contract. For example, if there is a contract between A and B, B may transfer his leg of the contract to C, A may transfer it to D and so on. And therefore, the issue of creditworthiness becomes very significant, and this kind of trading would not be possible unless that default risk factor is eliminated from the futures transactions. How this is done is very important. That forms the core, the cornerstone of the development of the theory of futures. So, let us move to that. Before that, some terminology. As I said, futures contracts have to be standardized. Therefore, the number of units of the underlying that constitute one contract or that are covered by one futures contract is also standardized. It is called the lot size. Of course, it varies from underlying to underlying. You may have different lot sizes in the context of different index futures, in the context of US dollars, in the context of GB pound, in the context of various securities, various shares on which futures are available. That notwithstanding that, the lot size for a particular type of contract is standardized. Then there is the concept of contract value. The contract value is the value of the entire contract. That means, it is the product of the lot size and the futures price per unit of the underlying asset. Expiry date is the date on which the futures contract mature for delivery. Now, there is a concept called margin, which was probably also embedded in forward contracts, but forward contracts being private, the margin component also was decided privately. The banks could require the borrower or the party that is long in the forward contract to deposit a certain amount of money, so that it honors its leg of the contract, but that margin amount is also decided after or through negotiation between the two parties. In the futures contract, of course, even the margin is standardized. There are different types of margins. So, that is what we shall be talking about, these kind of things. Now, as I mentioned, futures contracts are similar to forward contracts in the sense that we agree on the terms today and they entail the delivery of the asset or the transfer of the asset and the payment of the price at a later date. However, to facilitate or to encourage greater tradability, to encourage liquidity, the concept of cash settlement has also been evolved. In the case of cash settlement, what happens is the physical delivery of the underlying asset does not take place. So, there are two ways in which futures contracts can be settled. One is by actual physical delivery of the underlying asset, and the other is when physical delivery of the underlying asset is not done, but a certain amount of cash is transferred to the margin account. What is that certain amount of cash? Well, that would be as you will see later, that would be obtained by marking the final settlement price of the futures contract equal to the spot price prevailing on the date of maturity of the futures contract, because no arbitrage dictates that on the final date of settlement of the futures contract, the futures price as prevailing on that date must equal the spot price as prevailing on that date. That is because of the convergence of the futures and spot prices, and that is mandated by no arbitrage considerations, as we shall discuss in a few minutes. So, the issue is we can have physical settlement, we can also have cash settlement, but whether a particular contract entails physical settlement or cash settlement must be embedded in that contract. You cannot, after the contract has come into existence, one party cannot say that okay, I want physical settlement, the other party say I want cash settlement. That cannot happen. The terms as to settlement are clearly specified in the futures contract and in the requirements of the exchange at which they are traded. Most of the derivatives, in fact, that are traded on Indian exchanges are cash settled. How are these contracts created? These contracts are notified for trading by the relevant exchange. For example, if NSE is the underlying exchange at which trading takes place, then NSE notifies the contracts as and when appropriate for trading. As and when appropriate is explained here. Futures contract as of today are 3-month contracts. That means, each contract has a life of 3 months. Therefore, now the contracts are so organized, the cycle of contracts are so organized that at any point in time, for example, if you are talking at 1st of January, there are 3 contracts that are being traded. One is the near month settlement, near month delivery contract, the middle month delivery contract or the mid month delivery contract, and the far month delivery contract. These 3 contracts are available for trading or exist in the market for trading at any point in time: the near month delivery, the mid month delivery, and the far month delivery. Now, as and when the near month trading in the near month delivery stops, because it has reached maturity and because final settlement is to take place, the exchange notifies a fresh contract with a 3-month cycle. As a result of which, this new contract replaces the existing contract which is now expired, and its delivery will take place at the end of 3 months from today. And again we have a cycle where 3 contracts or 3 monthly settlement contracts are available for trading near. For example, in January we will have January settlement, February settlement and March settlement. When the January settlement contract expires, a fresh contract with April settlement will come into play, and that is how it operates. Whenever a contract is notified by the exchange, there are a lot of, as I mentioned, they have to be standardized, and once they are standardized, at least these fundamental constituents which are mentioned on this slide must be clearly spelled out in the futures contract: the nature and the quality of the underlying asset, the size of the contract, the mode of settlement, whether it is physical settlement or cash settlement. If it is physical settlement, the delivery arrangements, the delivery months when the contract is to expire, and the price and position limits, if any, that are there in a situation to contain volatility within certain bounds. Now we come to the issue of default risk. As I mentioned, forward contracts are private contracts, as a result of which the parties are free to assess the default risk of the other party in any mechanism that they want, in any form that they want, in any manner that they want. And by entering into the contract, there is implied acquiescence of the default risk of the other party, and the world at large is not affected. In futures, however, if trading is to be uninhibited, if the trades from one party to another is to be free of any restrictions or any implications as to the default, possibility of default by one of the parties, the default risk has to be eliminated. Now, this elimination of default risk at the level of the market player, at the level of the investor, at the lowest level, is through the clearing house. In other words, the clearing house ensures, in fact, it is one of the fundamental functions of the clearing house of the exchange, that it guarantees the performance of both the legs of the contract. Once the futures contract comes into existence, the clearing house intervenes as a middleman, and it guarantees the performance of both the legs of the contract, as a result of which both legs of the contract can be traded independently of each other without any issue in relation to default risk. So, that is one fundamental function of the clearing house, which is performed through the stock exchange or the futures exchange. So, once this performance of the clearing house or the requirement or the guaranteeing of performance of the two legs of the contract by the clearing house is understood, we note there are certain additional functions of the clearing house, which of course relate to the accounting for the transactions during the day conducted by various members of the clearing house. You see, at the lowest we have different tiers of players in the futures market, just like in the stock market. We start with the investor at the lowest level. Investor transacts through the brokers. Brokers, either they are themselves clearinghouse members, or if they are not themselves clearinghouse members, they transact their business through the clearinghouse members, who are the final tier, who constitute the clearinghouse. So, the clearinghouse keeps track of all the trades of its clearinghouse members, and the information percolates downwards from one tier to the other. Now, we have just emphasized that the clearinghouse or the exchange, clearinghouse is a part of the exchange. So, the clearinghouse guarantees the performance of the futures contract, of both the legs to the futures contract. But then there must be certain mechanisms put in place. It has to be that the clearinghouse itself protects itself against the possibility of default by members or by investors holding positions in the futures contracts. some mechanism must be in existence or must have to be put in place, that the clearing house itself is also protected against defaults by members. How does it do? It's a very interesting mechanism, or it's a set of operations that manage to curtail the risk to a risk of default at the level of the clearing house to next to nothing. Clearing house is well protected by managing or by these two operations operating in conjunction, and they are called marking to market coupled with the margining system. Let us first talk about marking to market. Marking to market, as its name suggests, when we talked about forward contracts, we discussed the issue that although at inception of the contract the value of the forward contract is 0, but gradually with the passage of time, as the perception of the community, of the investors, of the market players changes about the price of the underlying asset on the date of maturity of the forward contract initially agreed upon, that forward contract can acquire a value. We have talked about that, and that is in fact the reason why a forward contract is called a derivative instrument, because its value changes due to the perception of the change possibility of the change in value of the underlying on the date of maturity. The underlying value on the date of maturity of the forward contract is a random variable. It can take different values with a probability distribution. Although technically, because futures are traded, therefore their value or their price is dictated by the forces of demand and supply acting in conjunction. At a more micro level, at a more fundamental level, when we talk about how this demand and supply is created, then that issue of perception of the future price of the underlying comes into relevance. Nevertheless, when we talk about marking to market, because the futures price also fluctuates, because the future price also changes, marking to market is a process whereby at the end of each day a settlement price is arrived at. That settlement price is usually the weighted average of the trades or the prices of the trades that take place during the last half hour of settlement, last half hour of trading for the day. So, once that settlement price, which has been worked out as per a particular formula, is arrived at, all the contracts in existence, irrespective of their origin, date of origin, and irrespective of their previous history, are marked to the current settlement price. So, this process is repeated every day. In other words, at the end of trading every day, all contracts in the market pertaining to a particular maturity and a particular underlying are settled at a particular price, and this process is called marking to market. So, what are the implications of this? That is very important, and the difference between the previous day's closing and today's closing is transferred to the margin accounts of the clearinghouse members and thereby it percolates down to the investor's margin account with his broker. So, what is the implication of this? Let us try to understand. For the moment we ignore time value of money. We take up the same example that we did earlier in the context of forward contracts. There is a forward contract, there is a futures contract that we have taken up at January 1, a long position in a futures contract in January 1, which entails the delivery of the underlying asset on December 31st at a price of 75 rupees in units of money. On January 2, due to a radical change in perception of the investors, of the market players about the price of the underlying asset as on 31st December, the current futures price changes to 90 rupees. In other words, if you enter into a futures contract, you are in effect entering into a contract whereby you will pay 90 rupees and you will get 1 unit of the underlying asset. So, let us repeat. On January 1, if you entered into a futures contract, you could get the same underlying asset for 75 rupees. On January 2, if you entered into the another futures contract underlying this same asset, you have to pay 90 rupees. Now, obviously, there has been an increase of 15 rupees. In other words, the position as on January 2 for the party who is long, that means the party is going to buy the asset, is worse than the position as of the party who is holding the contract that was initiated on January 1, because January 1 contract would give you the same underlying for 75 rupees and January 2 gives the same underlying on the same date for 90 rupees. So, January 2 has a disadvantage. January 2 contract has a disadvantage compared to the January 1 contract, and that disadvantage is 15 rupees. Let us ignore time value of money, I reiterate. So, in other words, if I pay 15 rupees, which is the disadvantage of the January 2 contract, if I pay 15 rupees to the January 1 party, that disadvantage is annulled, because the disadvantage is of 15 rupees. So, if I pay 15 rupees to the January 1, the party holding the January 1 contract, then both the contracts become equal in value, because then both the contracts are impliedly involving asset or the acquisition of asset at 90 rupees. This is the process which is called marking to market. The profit that A obtained, let us call it A, by his long position in the January 1 contract of 15 rupees, once it is transferred to his account, then this contract becomes equal to the position that is of a January 2 contract, which is of 90 rupees. In other words, by transferring the change in value between January 1 and January 2 to the margin accounts of the two parties, one party obviously if this party is benefiting, there would be a counterparty who is losing. So, by transferring this difference in value to the respective margin accounts, the accounts are translated to the current market value. The contracts are translated to the current market value. Therefore, once this 15 rupees benefit is transferred to the party A, then A and the party B become on the same platform. This is the principle of marking to market. That is why it is called marking to market, because every contract in existence in relation to the underlying same underlying and in relation to the same expiry, same maturity is marked to the current market price by transfer of money, and this is done every day. That is important. This is done every day. So, what are the implications of this? Now, another important point is that even on the day where in which you take a position, that is day 0, on the day on which you take a position in the futures contract, at the end of settlement, at the point of settlement of that particular day, the difference between the price at which you took the position and the settlement price is transferred to your margin account. So, this operates from day 0, not from day 1. So, what is the implication? This is very interesting. Now, because at the end of every day these contracts are marked to market and the difference is transferred to the margin account, therefore, if a party commits default, there are two things. If a party commits default, what happens? Number 1, that default will be restricted to 1 day's price change, because the previous day's price change has already been incorporated into the contract and has been transferred to the margin accounts. And if there is a shortfall in margin, the party would have brought the money by now. So, the worst case scenario is that the 1 day's fluctuation in price may be the basis of default, may be the default amount that arises because of this marking to market. And the second thing is that this default is detected immediately on the following day. Normally settlements are on T plus 1 basis, therefore, defaults are detected on the next following day. These two things imply what? Let us compare it with the forward contract. In the forward contract, what happens? You take a position at a given point in time, there is no cash flow, let us ignore margins, there is no cash flow at this point. At maturity, you pay the money, you get the underlying asset. Because there could be a significant time gap between t equal to 0, which is today, and t equal to capital T, which is the maturity of the forward contract, the entire cumulative effect of the price change, if there is any price change. For example, let us say you entered into a forward contract as on t equal to 0 at a price of rupees 75, and you find that on maturity the price has gone up to rupees 180. The spot price as on maturity is 180, you have to deliver the asset, you taken a short position in the forward contract. Now, the entire impact of 105 rupees is felt by you on the date of maturity of the forward contract. In between nothing happens because there is no cash flow, there is no actual physical movement of funds. But at the date of maturity, when you decide or when you are mandated to pay to deliver your asset, you realize that I am delivering an asset worth 180 rupees for only 75 rupees, almost 105 rupees loss I am making. In the case of a futures contract, because this whole gap of 105 rupees would probably be split into, maybe not exactly, but because there is an element of randomness, as I mentioned earlier, these prices are market determined by demand and supply forces. So, there would be an element of randomness embedded in them, but nevertheless, as some of you may know standard deviation scales as root t. So, smaller the time period, lesser is the level of fluctuation, at least at the average level. So, that being the case, when we have daily settlements, the fluctuations or the price changes are far smaller, and therefore, the incentive to default becomes much less. When you are suddenly faced with the pinch of 105 rupees of 50% or 100% change in price, the motivation to default is far more gigantic compared to a splitted default, a daily default of maybe fractions of percentages. And the second thing is, you can always get out of these futures contracts, you can always take a counter position and get out of the futures contract, you can close out your position in the futures contract at any time you like, which benefit also is not available. So, defaults in the case of futures contracts, because of their marking to market, are confined to 1 day's default, which is very small compared to the situation that we may face in a forward contract. This is one reason. And the second reason is, now we come to the margining system. Whatever possibility still remains of a default is captured by the margining system. We will continue from here.